Hey everybody, this is Hutch with BankingTruths.com, and today we're going to talk about first-year dump-ins into whole life. Sounds really great in theory, and we can always design it that way, but it may not be optimal for you, and that's what this video is going to show you. So, everybody has some kind of monthly number that they can put into a whole life policy that they know they can do no matter what, but a lot of times they have money stashed on the side in checking, savings, CDs. Maybe they sold a property. Maybe they got an inheritance. Maybe they're cashing out of stocks and they just want to sit on the sidelines for a little bit. And for whatever reason, they want to do this kind of massive or this disproportionate dumping in the first year. Well, what I can tell you is that the way that all whole life policies are designed, and all insurance policies for that matter, there's a minimum and a maximum that you can put in, and that's based on how much death benefit is there. And oftentimes we're trying to shrink wrap the least amount of death benefit around your cash so you can actually get the most robust cash value growth. And if you want to put in more the first year, that's fine. We just need to raise the level of death benefit, which is the biggest determinant of the fees, charges, our commissions. Even if you are using term riders, the death benefit is where most of that stuff comes from. It's not so much how much money you're putting into the policy, it's more so how much death benefit it's buying, if that makes sense. And so we recently had a prospective client who came to us online say, you know, I'm talking to this other group and they had this special policy that had a special rider that allowed for a first year dumping. And I thought, well, that's interesting. Do they have some kind of proprietary private letter ruling with the IRS that allows them to violate these MEC limits more so than other carriers? And so we went into the lab and we started playing around with it to see how it worked. And so this is the other carrier that was recommended. You can see that the annual premium was about $20,000. The initial face amount is very, very small. And then there's this lump sum amount. And sure enough, it was a rider that allowed them to do this. You couldn't do any more than the 20 in any other year, but you could do the 80. And what we saw is it actually raised the death benefit pretty substantially over the same policy with just $20,000. You can see this is the initial premium of $20,000. The face amount is $37,000 compared to $117,000. But if you look at the total death benefit, and this is including the term rider and everything, you can see it's about a $300,000 policy. But when you want to drop that extra 80 in, it brings it up to, it adds basically $1 million of a term rider that actually grows with over the first 7 years. So what's interesting is if we took the exact same cash flow, so $100,000 year one, and then 6 premiums of $20,000, and then we just do an RPU just to really make the thing maximum efficiency. And we compared that to $220,000 going in from what we found to be the best performing policy of 2022. And by the way, if you haven't seen our update of 2022's best whole life policy, we really analyzed the top 4. These are some of the biggest, oldest mutual companies in this video here or in the description. Check that out when you have a chance. But take a look when we looked at the best performer and we threw in the same $220,000 of total premium, but we feathered it in a little slower. So we could fit the 100 all at once, but we need a lot more death benefit. And so we decided to shrink wrap death benefit and then put in 55 year one, 55 year two. That's total of 110. And in the other policy, you'd still have 120. So we added an extra 10 in year 3 with 30, and then they're equalized and they're both paying $20,000 premiums until year 7. RPU, what you can see is that the first year dump in this special rider, this gimmicky rider, it's actually winning early cash value until about year 9. Year 8, things are pretty close. And in year 9, you can see that our feathered in policy starts to pull ahead. And you can even see the dividends are pretty close once we do the RPU, but then our policy starts really crushing on down the line. Total cash value, get out all the way to year 25. You have an extra $87,000 of cash, an extra $220,000 of death benefit. simply by just feathering into not some kind of special rider, but just a smaller policy, but allows for somebody to take that extra $80,000 they had and put it in there. Now, this isn't even totally optimal. Like, you could and you should pay as much as you can for as long as you can. And remember, the rider didn't allow him to do it. You could do that extra 81 time and then it's just straight 20s. But with our policy, you could actually do quite a bit. Now, anywhere in between, you could do 8 premium payments of $55,000 and then some. You see a bunch of wonky numbers going on down, and that's really just because we're bumping things right up to the IRS limits. Another thing you can do is, instead of the $55,000, this is the same 220 going in over 7 years. We just shrink wrap the death benefit a little bit further. So instead of a little bit over $1 million to start with, there's 825,000. We do 45, 45, 45. That's 135,000 in the first 3 years, versus there's 140 in the first year dump-in competition policy, and then so we add an extra 5,000 in the 4th year, and then 20, 20, 20, just the same as this. And what you can see is, by shrink wrapping the death benefit even further, you actually end up with more cash value. Instead of 590 year 25, you actually end up with 600,000, and instead of 918,000 of death benefit, you have 930. So this was even more efficient. So the only problem with doing the $45,000 policy is you have now shrunk your capacity. So you can only do 45,000 8 times, and that's your top end here. And after that, you have smaller amounts you can contribute in the future than if you had done the 55,000, which you could do 8 times, and then bigger numbers. You also have more death benefit. At the end of the study periods, you could see you end up with hundreds of thousands of more cash value and death benefit if you allow yourself that capacity. And I know what a lot of you are thinking, like, Hutch, I don't know if I can do that. I don't know if my income's going to grow. I don't know if my real estate investments are going to work out, and I don't want to give myself too big of a bill. Well, let's just isolate the 7 pays again of the 55,000 to show the efficiency of that extra payment in case you needed to borrow against the policy itself to do it. Let's just see how efficient they are and if you could get comfortable doing it. Because with the first example, which was, remember, we just did the 220,000 total dollars, which was the same as the 100 in the 20s. But with our policy, we feathered in 55,000 twice, then 30, then 20, 20, 20, 20, 20, 4 20s total. What if we did the same policy? You can see the $1,011,000 death benefit, $1,011,000, and we did 55,000 7 times. And if we just isolate those extra payments, well, they're the same the first 2 years, and then an additional 25,000 on top of the 30 to bring it to 55, and then an additional 35,000 over the 20s to bring it to 55. So you would have paid an extra $165,000, and you would have gotten an extra 201,000. The 165 would have turned to 201. What was the rate of return of those payments? Well, it was 4.129%. And some of you are going, okay, well, that's cool, but what's important about that number is, remember, currently you can borrow against these policies at 3, sometimes even less, depending on how big your line of credit is. But if you could get an extra percent arbitrage, why wouldn't you take it and end up with more death benefit, actually considerably more, at the end of when you do the RPU at the end of the 7th year? You have just over $1 million versus $1,391. And then when you RPU the policy that you didn't max fund, there's only 570 of death benefit, versus when you do max fund, that's all buying PUAs. So when you RPU it, there's a lot of extra paid up death benefit. In fact, over $1 million worth. And again, if we fast forward over time, putting no payments into these policies, you end up, instead of with 592,000 of cash value after the 25th year, you end up with $1,050,000. So that's a lot of extra stuff. And I know you guys are saying, well, but wait a second, what if I'm borrowing this stuff? Remember, at any time you can go ahead and cash, these are PUAs, you can cash them out and pay down the loan. So if you could pick up extra arbitrage, why not? So if that works, then why stop there? So we can put in 55,000 8 times. After that, some wonky numbers, but we're taking this thing up to the MEC limits. And if we look at the end of year 21, you can see there's $1.478 million. If we subtract that by 484,377, that's what there would be in the 55,000. Then we get an extra $994,000. Now that's a big deal because a lot of people are looking to find ways to get extra money into savings, and we contend that getting $1 wearing multiple hats is the way to do it. So if you didn't have the cash flow, then you would borrow against the policy itself, continue to get lines of credit increase, or if you're taking the policy loan, then that just automatically happens for you. And then you'd have all these extra payments to receive this extra $994,000. Truth be told, you feathered in an extra $569,000 using other people's money. But by doing so, you earn an extra over 5% on that money. So if you could borrow at less than 5, wouldn't this be a good thing? Probably so. What if you could borrow at 3? Keep in mind that with the policy, at any time, if it ceased to be a good deal, you could do an RPU, a reduce paid up, and you could also use the RPU to just take out your loan too. But if it's working, why not continue in this way? Not only end up with extra cash value, but extra death benefit. So what do we learn here? Well, it's the same thing I always tell you guys. One is always double check the rhetoric with math. And the other one is one of my favorite sayings: there's no deals in insurance. Everything's priced perfectly. So when you hear of this thing like our company does this gimmicky thing where you have a special rider where you can do a first year dump in, it's the tax code. They don't have any kind of proprietary exception on the tax code. And so is there a better way to accomplish what you're looking at? That's when you need a team to help you test and measure these assumptions to help you arrive at the most optimized situation. And if you have a first year dump in to put into whole life, great. That's awesome. That gives you a lot of flexibility, but maybe there's a better way. Sure, if you want it, we can build you that much death benefit. But if you don't keep funding at that level, it's just not going to be as efficient as if you did something that maybe you feather it in just a little bit slower. And also, you learn that if you're going to create a big enough policy to handle these dump-ins, you want to do them as long as possible, even if you have to borrow against the policy equity itself, whether that be the policy loan, or if you can get a lower interest rate line of credit, go ahead. These are PUAs. Once you pay them, no further payments are due. And if for some reason you want to extinguish the loan, great. You can go ahead and surrender the PUAs to do it. People hear the word borrow and debt and they freak out. But remember, if you have a corresponding asset that's growing for you at greater than the rate that you can service that debt at, and you can extinguish that debt at any time with that asset, are you really in debt? I would say no. Hope this helps. If you want help looking at some customized specs for your situation, we're happy to run the top 2-3 companies, whatever you need to see. And as long as you want to work with us and write the business with us, we don't really care which company you choose. Hope to talk to you soon.